Welcome to Friday Frameworks, where ambitious leaders get the practical strategies and sharp insights needed to drive real business growth. I'm your host, George Mayfield, and you're listening to our 7-part series on financial growth and exit planning. This week, we're tackling a topic that's on every leader's mind right now, securing funding for growth. Specifically, how to attract lenders and investors to fuel your scaling ambitions. A few years ago, I worked with a team who ran a family-owned packaging plant, making steady progress in the 20 million range. They built a reputation for top-notch quality and responsiveness. But when the demand spiked, they hit a ceiling with their existing working capital. Expansion was the next logical step, but they needed outside funding to upgrade equipment and scale production. The owners maintained control and a strong culture, but like many of you, they felt a bit uneasy about inviting outsiders into their financial mix. They navigated that discomfort, took the right strategic steps, and ultimately secured a multi-million-dollar investment from an industry-focused private equity group. Within 24 months, they doubled capacity and saw a 38% boost in EBITDA. The lesson? Reluctance is natural, but so is opportunity, if you know where to look and how to position your business. So here's what you need to know if you're considering funding options to scale your manufacturing business. Here are 5 tips to change your trajectory. Did you know most lenders and investors care less about your current revenue and more about your growth potential backed by solid operational data? The stronger your data story, the more compelling your pitch. You will attract better funding offers if you clarify the why for your scaling. Connecting your expansion to clear market demand, customer contracts, or new technology gets attention from investors who value a well-defined return. How do you get lenders to say yes? Focus on building strong relationships with decision makers early. Schedule introductory meetings before you're ready to raise capital so you're on their radar and you can start overcoming objections in advance. Would you rather borrow from a bank at a lower rate with more restrictions or bring on an investor who shares your strategic vision but expects a seat at the table? Knowing the pros and cons of each funding route will help align your strategy with your appetite for control and partnership. Do you prioritize speed or flexibility in funding? Fast capital can help you get ahead of the competition, but may come with tighter terms. Flexible investors may wait for the right window, but could bring mentorship and industry connections to support your long-term growth. Growth is never about the numbers. It's about vision, preparation, and having the right financial partners in your corner. Take time this week to assess what kind of funding fits your manufacturing growth story. Network with potential partners even before you need capital, and stay tuned for our next episode where we'll break down the operational due diligence and debt structuring in more detail. For frameworks, resources, and tools to sharpen your strategy, visit imgeorgemayfield.com to connect with me directly. Thanks for tuning in to Friday Frameworks, and remember, to lead with conviction is to grow with intention. See you next Friday.